Hello, my name is Delia David. My metric number is BB19110953. I will present the topic 4, which is household saving and investment decision for household leverage and stock market investment decisions. Next, I will present about the introduction. Household is a group of people, often a family or who live together, by Cambridge Dictionary in 2022. The focus of this research is to examine how household leverage affects household stock market investment decisions. Two variables that influence respondents' stock market investing choices is dummy variables and the stock market investment as a percentage of the overall investment of participants. For data and summary statistic, this is table 1 for variable definitions and summary statistic. There are 3,122 genuine respondents. 1,562 of them are active in the stock market. The stock market accounts for 31% of respondents' total financial assets on average. Next, I will move to the household leverage and stock market investment decisions. First, I will talk about stock market participators versus non-participators. This is table 2 for stock market participators versus non-participators. Household debt has an impact on a participant's stock market investment decision. Better education degrees, higher earnings, and more incredible wealth are more likely to be held by participants. For the next point is probit regressions of stock market participation decision on leverage. In the probit regressions, rising household leverage has an economically and statistically significant barrier effect on responders' stock market participation. The effect was unaffected by well-known criteria including wealth, income, age, gender, education level, and financial education experience. The percentage from table 3 of the participants' total debt to total asset is leverage essential independent variable. For the next point is OLS regressions of stock investment rate on leverage for participators. This study looks at how household leverage affects stock market involvement in the United States. These variables derive also a relation of stock plus equity investment ownership with monetary support. Greater household borrowing is connected with higher stock and mutual fund investment rates for stock market participants. The stock market's investment rate is adversely connected with respondents' wealth and income. Table 3 is household leverage and stock market participation. And table 4 is household leverage and stock investment rate for participators. Next, I will present about the underlying mechanisms by financial constraint and risk aversion. Financial constraint is households' capacity to borrow money while cash strapped. The financial restriction of households is measured using the constraint scale, which range from 0 to 1, which is least severe, to 5, which is most severe. Researchers observe that the group with much more severe financial limitations has a lower estimated coefficient of leverage. Financial constraints could not discuss the influence on household leverage open stock market participation, but they can be used as a moderator. Household leverage also increased the investment rate on equities and mutual funds for respondents with few severe financial constraints. Table 5 is underlying mechanism by financial constraint. For risk aversion, financial constraints could not describe the impact on household leverage open stock market participation, but they did serve as a valid moderating variable. The entire sample has been divided into 5 categories. Because the barrier effect only occurs while responders' risk aversion is considerable, risk aversion might assist describe the impact on household leverage open stock market participation. The larger the augmentation of household leverage in the interest rate on equities and mutual funds, the less risk averse the participants are. Table 6 is underlying mechanism by risk aversion. In conclusion, this study discovered that household indebtedness has an obstacle impact on stock market involvement. Responders with the level of leverage are much less likely to invest in the stock market. Next, higher household borrowing is linked to stock market participants' higher stock and mutual fund investment rates. Investors with more outstanding credit and debt are more likely to invest in riskier assets. The obstacle impact on household leverage upon stock market participation works when households are incredibly risk-averse. In contrast, the enhancement influence of household leverage only works when households are incredibly risk-averse.